Welcome to the deep dive. Today, we're taking a deep dive into Bajaj Housing Finance Limited and how they did in Q3 of fiscal year 2025. You sent over a ton of information, financials, press releases, even a recording of their earnings call. You really went all out. Looks like we've got a lot to cover.
It's incredible what companies are willing to share publicly these days. I think our goal today should be to sift through all this and find the most important takeaways for our listeners.
Yeah, definitely. So, what stood out to you the most when you first looked at all of this?
Well, Bajaj Housing Finance Limited, or BHF for short, really had a phenomenal quarter. The first thing I noticed was their assets under management, or AUM, grew by a massive 26% year over year. They're now managing over 1,008,314 crore.
Wow, that's a ton of money. So did that growth translate into profits?
Absolutely. Both profit before tax PBT and profit after tax PT increased by a solid 25%. They're clearly doing something right.
Okay, I'm impressed. But you always like to dig a little deeper. What about their performance in different segments of the market? Did you find anything interesting there?
Definitely. Their core business, the home loan segment, saw a respectable 23% growth. Loans against property, or LAP, went up by 19%. And lease rental discounting, LRD for short, jumped by 26%. But here's where it gets really exciting. Their developer finance, or DF segment, experienced a whopping 59% increase.
59%, that's huge. What's driving that kind of growth in developer finance?
That's a great question. It looks like BHF is strategically moving toward what they're calling near-prime and affordable housing segments. It's a smart move considering the government is really emphasizing affordable housing these days.
Makes sense. Tapping into a growing market and maybe aiming for higher returns. But with all this talk of growth, we can't ignore the rumors about a slowdown in the Indian real estate market. It seems like everyone's talking about it, and BHF is deeply invested in real estate. How are they handling this potential turbulence?
You're right. It's definitely something to consider. They did acknowledge in their earnings call that sales have been a little slower than they had hoped for, especially in their developer finance book. However, even with the slowdown, their DF segment is still seeing impressive growth.
Okay, so they're not just being overly optimistic. Do they have any kind of plan to manage the risks in this market?
Well, they seem to think so. They emphasize their confidence in their risk management strategy. They highlighted a granular approach to developer finance. They talked about focusing on construction milestones and using an early sweep system to collect repayments. It sounds like they're trying to be very hands-on to minimize potential losses.
So cautiously optimistic.
Exactly. Now, this is where it gets even more interesting. There's some debate going on in the industry about the role of developer finance as a growth engine.
Oh, tell me more. What are the different sides of this debate?
Well, BHF sees DF not only as a path to growth, but also as a way to enhance returns, and even as a channel to attract more home loan customers. It's like they're trying to create synergy across different parts of their business.
I see, I see. But isn't it risky to rely so heavily on a segment that can be affected by the ups and downs of the market?
That's a valid concern. It seems BHF is trying to strike the right balance. They're limiting their exposure to developer finance to around 12–15% of their total portfolio. They're aiming to seize the opportunity while carefully managing the risks involved.
That makes sense. Now, I'm curious about their lease rental discounting portfolio, or LRD. They claim zero gross non-performing assets, or GNPA, which sounds almost too good to be true. What's their secret?
Their LRD strategy is quite interesting, actually. They have a double security structure in place, escrowed cash flows, and mortgage properties, like having two layers of protection.
So they're really minimizing their risk. That explains their impressive track record in this area. Speaking of the future, what are BHF's goals for the next few years? What's their roadmap for success?
They've set some pretty ambitious targets, but they seem achievable. In the medium term, they're aiming for 24–26% AUM growth, and they want to reduce their operating expenses. Specifically, they're targeting an operating expenses to net total income ratio of 14–15%.
So they want to become leaner and more efficient while expanding their portfolio. That sounds like a challenge. Do you think they can actually pull it off?
They seem pretty confident. Their plan revolves around continued growth in their core home loan segment and expanding their presence in those near-prime and affordable housing markets.
Wouldn't that potentially hurt their existing prime segment by drawing customers away?
It's a delicate balance for sure, but they seem to believe these segments can coexist and even benefit each other. Remember, the affordable housing market in India is huge and largely untapped. There's plenty of room for growth across all segments.
That's true. We can't talk about financials without mentioning net interest margin, or NI. Are investors concerned about potential compression in BHF's NI? What's the company's take on this?
They're acknowledging that NIM could be squeezed a bit due to factors like yield compression and increased competition, especially as they move into these new markets. However, they've incorporated these challenges into their medium-term guidance. It seems like they're confident they can manage these pressures effectively.
So they're not shying away from the potential difficulties. That's refreshing. One last question before we move on. They've decided to increase their leverage from 7x to 8x, which has raised some eyebrows. Can you explain why they're making this move?
It's a classic risk-reward situation.
Yeah.
Essentially, you're saying as they grow, they're willing to take on a bit more leverage to accelerate things. It's a calculated gamble, but they believe their strong risk management practices and the potential for higher returns justify the risk.
This has been a fascinating deep dive into Bajaj Housing Finance Limited's Q3 FY25 performance so far. We've seen impressive growth, ambitious plans, and a healthy dose of cautious optimism. But we've only just scratched the surface. Stay tuned for part 2, where we'll delve deeper into their risk management approach. We'll break down their financial statements and explore the potential impact of their strategic decisions on their future performance. All right, let's get back to our deep dive on Bajaj Housing Finance Limited. We left off talking about BHF's decision to increase their leverage. That's a pretty bold move, especially in this current market. What are your thoughts on that? Any red flags popping up for you?
Not necessarily. Leverage can be a really effective tool when used correctly. It can boost your returns, of course, but it can also make losses worse. It all comes down to finding that sweet spot, and it seems like BHF understands that.
Okay, so walk me through their risk management strategy. What are they doing to make sure this leverage increase doesn't backfire?
They've got a multi-layered approach to managing risk. First and foremost, they have a very strict process for assessing creditworthiness. They're not just giving out loans to anyone. They're really digging into borrowers' financial history, looking for a solid track record of repayment. They're being very diligent in who they lend to.
That makes sense. What other safeguards do they have in place?
Collateral is another big part of their risk management. They require a substantial amount of collateral for their loans, especially in the developer finance segment. That means if a borrower defaults, BHF can seize the asset and recover a good portion of their investment. It's a classic way to minimize potential losses.
It sounds like they're trying to cover all their bases.
Yeah,
But even with the best risk management, things can still go wrong. Are there any other safety nets they have in place?
absolutely. They have a really robust system for monitoring their loans. They don't just lend the money and forget about it. They closely track how their loans are performing, looking for early warning signs of potential trouble. This allows them to intervene early, potentially restructure a loan, and ultimately reduce their losses.
So they're not just reacting to problems, they're being proactive and trying to prevent them. That's smart. Now let's dive into their financial statements. What can the numbers tell us about their overall financial health?
Well, their balance sheet looks pretty solid. They have a good mix of assets, their liabilities are manageable, and their capital adequacy ratio is well above what regulators require. They seem to be in a good position to weather any storms that might come their way.
No major red flags there. What about their income statement? Is their core business generating enough revenue to support these ambitious growth plans?
Their core business, especially home loans, is doing well, but they are facing some pressure on their net interest margins. This is partly due to increased competition and the need to offer attractive rates to customers in these new markets they're targeting.
So it's a delicate balance. They need to grow the business but also maintain profitability. How are they planning to tackle this margin pressure?
They're working on several fronts. One is operational efficiency, streamlining processes, and using technology to do more with less. This helps them control costs and protect their margins.
So it's not just about making more money, it's about spending less too. Are they doing anything else to keep those profits up?
They're also trying to diversify their income streams. They're expanding into new areas like lease rental discounting and developer finance, which tend to have higher yields. This helps offset some of the pressure on margins from their core home loan business. A multi-pronged approach to profitability.
Very smart. Now let's go back to their strategic push into those near-prime and affordable housing segments. It seems like a promising opportunity, but also potentially risky. What are the biggest risks and rewards they need to be aware of?
You're absolutely right. It's high risk, high reward. These segments offer huge growth potential. They're largely untapped by traditional lenders, so there's
Yeah.
a lot of opportunity there.
Okay, I see the appeal. But what about the potential downsides?
The downside is that borrowers in these segments tend to be a bit riskier. They might have lower credit scores, less stable incomes, or a higher chance of defaulting on their loans. BHF will have to be extra careful with their credit assessment, collateral valuation, and loan monitoring processes.
It's a tightrope walk then, trying to balance growth with the need to be prudent. Do you think they're up for the challenge?
They seem to understand the risks and are actively taking steps to mitigate them. They're building specialized teams with expertise in these segments, using technology to enhance their risk assessment and monitoring capabilities, and partnering with local organizations to really understand the nuances of these markets.
It sounds like they're doing their due diligence and not just rushing in blindly. That's good to hear. Earlier, we were talking about their developer finance book. It's growing rapidly, but also facing some challenges from that potential real estate slowdown. What are some key metrics they're looking at to make sure this segment stays on track?
They're keeping a close eye on several things. First is the sales velocity of the projects they're financing. Are units selling at a good pace? Are developers meeting their sales targets? This gives them an idea of the underlying demand and whether the project will generate enough cash flow.
So sales are crucial. What else are they watching?
Construction progress is another big one. Are projects on schedule? Are developers staying within budget? Delays or cost overruns could be red flags signaling potential problems.
Sounds like they're acting as both financial analysts and project managers. What's their ultimate safety net if things start to go south with a project?
That's where their early sweep system comes in. This system allows them to start collecting repayments from developers as soon as sales begin, even if the project isn't 100% finished. It reduces their risk and helps them recoup their investment faster if a project runs into trouble.
It's like a built-in safety valve. Very clever. Let's zoom out a bit and talk about their overall strategy in the Indian financial landscape. What are their main competitive advantages? What sets them apart from everyone else?
One of their greatest strengths is definitely their strong brand and reputation. They're backed by the Bajaj Group, which is a very well-established and trusted name in India. This gives them a significant advantage when it comes to attracting customers and building trust.
So brand recognition is a big plus. What else do they have working in their favor?
They also have an extensive distribution network. They have a presence in most major cities and towns across India, giving them access to a very broad customer base. And they're also leveraging technology to expand their reach through online channels and mobile apps.
They're casting a wide net. But what about their actual products and services? What makes them stand out in such a competitive market?
They're known for being very customer-centric. They offer a wide range of loan products tailored to different needs. And they're known for having competitive interest rates, flexible repayment options, and really efficient loan processing. It seems like they're focused on making the borrowing experience as simple and straightforward as possible.
So it's a combination of a strong brand, a broad reach, and a focus on customer satisfaction. That's a winning formula. Now let's consider the bigger economic picture. How is the Indian economy performing, and how might that affect BHF's business in the future?
Well, the Indian economy is currently seeing strong growth. This is driven by several factors like strong domestic demand, government reforms, and a young and expanding workforce. This is definitely a good sign for BHF as it creates a favorable environment for both lending and borrowing.
So a healthy economy benefits everyone, but there are always risks, right?
Of course, inflation is a concern because it can erode purchasing power and drive borrowing costs up, and global economic conditions can always impact India's growth trajectory.
Positive momentum, but with a few potential bumps in the road. How is BHF preparing for these potential challenges?
They're taking a cautious yet optimistic approach. They're carefully monitoring economic indicators, adjusting their lending practices as needed, and diversifying their portfolio to manage risk. They're also investing in technology to become more efficient and adapt to any changing market conditions.
Sounds like they're staying nimble. Now, I want to shift gears a bit and talk about their corporate governance practices. Are they running a tight ship? Are they being transparent and accountable?
They have a solid track record when it comes to corporate governance. They have a clear framework in place, a diverse and experienced board of directors, and a strong focus on ethical conduct. They also seem committed to transparency and regularly disclose their financial performance and risk management practices.
So it looks like they're ticking all the right boxes when it comes to being a responsible corporate citizen. What about their social impact? Are they just focused on profits, or are they giving back to the community as well?
They're actually involved in a number of social initiatives. They're promoting financial literacy, supporting affordable housing projects, and working to empower women entrepreneurs. They seem to be using their resources to make a positive impact on society.
They're not just about making money. They're trying to make a difference. I like that. Okay, let's wrap up part 2 by looking ahead. What are some of the biggest opportunities and challenges on the horizon for BHF?
They seem well positioned for continued growth. The Indian mortgage market is massive and still has a lot of untapped potential. There's plenty of room for expansion, especially in those near-prime and affordable housing segments we discussed earlier.
So the sky's the limit.
Well, not quite. They'll face some stiff competition. Interest rates can be unpredictable, and regulations are constantly evolving. To really thrive in this environment, they'll need to remain agile and innovative while keeping their focus on their customers.
It's a marathon, not a sprint. They need to keep their eyes on the prize while navigating any obstacles that come up.
Exactly. And that's what makes their story so compelling. Join us for the final part of our deep dive, where we'll explore BHF's long-term growth strategy, analyze their competitive landscape, and discuss how emerging technologies might impact their business model.
All right, welcome back. It's time for the final part of our deep dive into Bajaj Housing Finance Limited. We've already covered so much, their financial strategy, the risks they face, and all those amazing opportunities. So let's talk long-term strategy now. What's their vision for the future? Where do they see themselves in, say, 5 or 10 years?
Well, it seems like their ultimate goal is to become the leading force in the Indian mortgage market. They want to be the go-to lender for home buyers across all segments, prime, affordable, you name it.
That's a pretty ambitious vision. How do they plan to achieve that? What's their game plan?
They're really focusing on a few key areas. First, expanding their reach, both geographically and digitally. They want to be present in every major city and town across India. And they're putting a lot of resources into technology to make their services available online and through mobile apps.
So they want to be accessible to everyone, no matter where they are or how they prefer to interact. What else is on their strategic roadmap?
Product innovation is a major focus for them. They're constantly developing new loan products that cater to specific customer needs. They're also exploring new technologies like AI and machine learning to make their risk assessment and loan processing more efficient.
So they're trying to stay ahead of the game, but of course they're not operating in a vacuum. What about their competition? Who else is out there, and how is BHF positioning itself to win?
The Indian mortgage market is super competitive. You've got banks, housing finance companies, even fintech startups, all vying for a piece of the pie. Some of BHF's biggest rivals include HDFC, LIC Housing Finance, and SBI.
So it's a crowded space. What are BHF's key advantages? What sets them apart from the competition?
They're really leveraging their strong brand recognition, their extensive distribution network, and that customer-centric approach to stand out. They're also focusing on specific niches like affordable housing and developer finance, where they see a chance to become a leader.
So they're playing to their strengths and focusing on areas where they have a competitive edge. Now, we can't ignore the elephant in the room technology. How is technology changing the financial services industry, and how is BHF adapting to this rapidly changing landscape?
Technology is transforming the financial services industry at an incredible pace. Fintech startups are coming up with innovative new solutions, customer expectations are shifting, and traditional business models are being challenged.
A time of both opportunity and disruption, for sure. How is BHF responding to these changes?
They're embracing technology as a key driver of growth and efficiency. They're investing in digital platforms to improve the customer experience, using data analytics to enhance risk management, and even exploring partnerships with fintech companies to expand their offerings.
So they're not just sitting back and watching, they're actively participating in the digital revolution. Well, as we wrap up our deep dive, what's the one key takeaway you'd like our listeners to remember about Bajaj Housing Finance Limited?
Bajaj Housing Finance Limited is a company that's definitely on the move. They're experiencing rapid growth, embracing innovation, and positioning themselves for a successful future in the dynamic Indian mortgage market.
There's certainly a company to keep an eye on. Thanks for joining us on this deep dive into Bajaj Housing Finance Limited. We've covered their financials, their strategy, all the risks and opportunities they face. We even talked about the broader economic landscape and the impact of technology. I hope you enjoyed the journey as much as we did.
It was a pleasure.
And that wraps up another episode of the Deep Dive. Until next time, keep learning, keep exploring, and keep diving deep.